please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
It's off the highs. The Nifty is just about crept back into the green, 5 points though. Bank Nifty is down a quarter, Midcap index is down 1.25, small cap index is down 2% now. Ashwani is with us as always to take us through what he's making of things. Ashwani, good morning. Your sense where the market's headed?
We are in a zone of choppiness where in the morning we rejected, yesterday's high of about 11,050, 11,070. But large stocks are still holding on. IT is positive. My sense is that there's been, the financials are kind of oversold. They came in for heavy selling. We've covered our Bank Nifty and now are long intraday on the Bank Nifty because this is not a bear market. And like Nifty has gone back into the green, I expect, even the Bank Nifty to show some amount of short covering. But the problem is in the mid caps because advance decline is basically 393 advances to 1206 declines. So on rallies, the mid caps you can go short on things like Canfin Home, that's a sell with a stop of 332, target of 316. IDBI is a sell with a stop of 54, target of 46. Reliance Capital is a sell with a stop of 371, target of 356. Overall, my view is that we may not cross 11,050, 11,070 substantially. Large caps will keep moving up and down, but mid caps will continue to make fresh lows. Even a lot of stocks in the mid caps are making fresh lows. So that remains the place where you can get short.
JSPL, Ashwani, any thoughts?
See, overall metals are not doing well. Vedanta isn't performing. So with companies which have extra problems, I think even their selling should come in. So my sense is that metals is one of the weaker plays. It's broken 200-day moving average today. Maybe 175, 180 is possible here.
Okay, Ashwani, we leave it there. Thank you very much for your time. Thank you for your trades. We speak with you in about an hour's time. We take a very quick break on that note. I mean, there is a small attempt at a time. We take a very quick break on that note. I mean, there is a small attempt at a recovery, I guess, if you want to call it that. The low on the Nifty was 10,999. We're about 30 points off the low now. The high was 11,071, so that is still about 40 points away. And actually now it's bang in the middle of that range between the high and the low.
Well, for the Nifty holding 11,000, we do have Vaibhav Sanghvi who's joining in to talk about the fundamentals of the market. He's from Avendus Capital Alternate Strategies. Vaibhav, hi. Thanks very much for joining in. Well, we've recouped back to 11,000 for the Nifty. Do you think that we're probably on our way to all-time highs? And if so, do you think that we can sustain?
No, I think, of course, there is some amount of buoyancy in the index. However, what we also need to see is basically the contributors to this index. Now, if you look, the rally has been pretty skewed in terms of the last 400 or 500 points of movement, whereas the broad-based market is pretty weak. So I do expect this trend to continue going forward as well, wherein your select large caps will continue to perform. Whereas the broader market would be continue to be under pressure.
Okay, so this is a result of what, Vaibhav, you think? That a few of these large caps, gains beget gains, as they say. So is that it? Market psychology, or it's earning certainty and that kind of thing?
I think it's a combination of all factors. Of course, market psychology does play an important part of it, but what we also need to understand is basically, there are some technical parameters in terms of how the, funds will be monitored going forward in terms of domestic funds. At the same time, what is happening is basically the global risk money, which is, which in terms of, which gives you buoyancy in terms of the stock price movement, is pretty much absent, and I don't think I don't estimate that it will come back soon. because what we are seeing is basically flight to safety both globally in terms of towards dollars and towards high yields of what US interest rates is doing too. So I guess it's combination of all factors rather than I would say pinpointing at a particular variable. But as I said, this is something which might continue for some period of time.
Mm-hmm. Okay, Vaibhav, we've got good numbers coming from TCS and Infosys reports later this evening. What's your sense in terms of what frontline IT could do, and maybe even what your stocks would be? I understand that you can't talk stocks, but I'm just trying my luck in any case.
No, I think, in all our conversation earlier as well, I mean, we've always maintained that IT is something we are pretty keen and bullish on, not because of only currency aspect, but we are seeing some amount of revenue trajectory, getting built up as well. At the same time, when global economy is growing, IT spending are going up, I don't see any much of a, major negative reason not to be, or, negative reason in this whole sector. Whereas going forward, yes, the valuations have moved up a little bit and is higher than average, but I am still very comfortable in the whole pack to hold at least for 1.5 years from here on.
Vaibhav, sorry, I saw, I think, do you believe oil is going to head it to 90? Is that what you believe?
No, I mean, there are a lot of factors which are again moving on those count in terms of Middle East tensions, Libya, what's happening in Libya or Venezuela, and apart from what's happening in Iran. And overall, over and above this, what Trump tweets also would do to oil is something one has to carefully understand. So I think in just pure demand-supply matrix, we might see buoyancy continue in the oil prices. Purely that the growth is, recovering in the global economy. So, purely on those parameters, we think that oil will remain pretty strong.
Well, we've got an M&A transaction which has taken place in the hospital space today, that is with Fortis and IHH. Vaibhav. The domestic industry via hospital companies, via diagnostic companies, is domestic healthcare space rather. Is that a space that you see some amount of future sustainable growth in, and would you be a buyer of stocks within that sector?
Sure. So in healthcare space, let's take two things, apart from. One is your pharma companies and one is your, these healthcare hospital business. Hospital business, we believe that it's a great story for operating leverage. And looking at the demographic profile, and the nature of illnesses which are coming, I think on a longer secular opportunity, there is definitely an opportunity there. Having said that, whether it would perform in 3 to 6 months, frankly, to be very honest, I have no clue about that. But in any case, the other part of the healthcare business, which is your pharma companies, I think one of the most important variables which was negative, which was US FDA concerns, are getting sorted out. At the same time, the pricing pressure still remains, but I think the negativity around this sector is incrementally getting less, and we are seeing some amount of stocks rebounding from the lower levels as well. There is definitely some interest in stock select opportunities in this sector.
Do you own SAIL in your portfolio? Steel Authority, Vaibhav?
I wouldn't be able to, go into the details of what I am holding onto my portfolio at this point.
Okay, fair enough. I mean, okay. But those are graphics. Some of the stocks are there. I mean, Aisha, SAIL, HDFC Bank, SBI, Infosys, TCS, HDFC, Maruti, etc. I mean, of course, Weber wouldn't want to dive into discussing individual names there. Weber, we'll leave it at that. Thank you very much for your time. Appreciate you joining in, and good speaking with you. Thanks indeed. So the news is that the Nifty is now up about 12 odd points or so, which means we are now 45 points off the low on the Nifty. The market is sold off again. We had about 13 points on the Nifty when we took that break. We're absolutely flat now, almost back in the red. No improvement in advanced decline. 1,500 stocks are lower compared to 500 stocks which stay in the green. My colleague Timsy Jaipuri is now joining in from Delhi. And what she's picking up from her sources is that the much-awaited draft of the new direct taxes law, which has gotten delayed, which is now due to be submitted to the CBDT in August later this year, will not be a very big deal in terms of big overhaul in direct taxes. Timsy, take it away.
Well, as you rightly mentioned, the redraft of the income tax law is unlikely to bring any major changes, is what we are hearing from my sources. And also, government is not in favor of any sweeping changes when it comes to a decision that the government needs to take. So it's both ways. Not enough scope available. That's what the direct taxes department feels. And secondly, even the government, the political leadership is not in favor of any sweeping changes. Revenue Department feels that there's not enough scope for further simplification of the IT law at this point in time, because already the major changes which were missing in the previous regime, which was when there was no guard, there were no provisions for POEM and also for BEPS. So they've already kicked in, and not major changes are required. But when it comes to the amendments that have already happened, the new draft might see just accommodating them in a more clear manner. And not just this, it is also likely to pitch for some changes in the when there were deals that, there should be some new changes that people should expect when it comes to tax slabs, and also that is also not going to come up. It will be only that the corporate tax reduction, which has been happening over the last 4 years, will now be a formal deal in this new draft. And yes, more of compliance, that is what we are going to see through this new draft. So all in, not many major changes, no sweeping changes is what government is looking at. So it is going to be a very slow, dull deal when it comes to the new proposed direct tax code. Let's see what happens when actually the panel submits its report. But yes, as of now, government not in favor of some new sweeping changes when it comes to the direct tax.
All right, Timsy, thanks very much for getting us that update. But let's talk stocks now. Yesterday, we reported that Reliance Industries has come back to being a $3 billion market cap company.
Sorry, 100 billion.
Sorry, $100 billion. Sorry. $100 billion market capitalization, $1 billion. Sorry. $100 billion market capitalization company. To talk more about that, we have Jal Irani of Edelweiss Financial Services joining in now. Jal, hi, thank you very much for that. Well, thank you very much for joining in. Well, it's just strength to strength for Reliance Industries, all the way since last year. And now it's almost at the cusp of 1,100 rupees. What's your sense in terms of where we could see Reliance Industries go from here on, and what could your earnings potential be based on the consolidated businesses it has?
So essentially, we have been very bullish on the stock. We've typically been the highest on the street. And in fact, our forecasts have been exceeded every time. I can see that happening again. If you look at even the last 2-3 years, which were meant to be a period when they were really in a capex phase and essentially the earnings were meant to be subdued, they've nearly achieved a 20% CAGR in earnings, even in a very lull period, not only for the company, but even for the market. As you know, earnings for the market hasn't grown really for the last 3 years. Now, Reliance is actually poised at a stage that about $55 billion of capex has become productive. So capital work in progress has been converted into productive assets versus $30 billion of producing assets prior to that. So now it's actually in a phase where the earnings are going to grow at least 20% per annum, if not more, potentially even accelerate. Interestingly, for pretty much all its major businesses, and in fact its biggest and flagship business, the petrochemical and refinery business, which will actually remain the largest business, all this has come together at a time when the industry background is also looking very strong. if you take, for example, their new petcoke gasification project, which is part of the refinery, and you'll recall the chairman, Mr. Mukesh Ambani, mentioned that now the DTA of that project has gone on stream. Now that project is fairly sensitive to oil prices, and at current oil prices, we believe that project would make more than a 30% ROE. This is a $5.5 billion project. So for all practical purposes, I think not only the company's plans have come together very well, but the market circumstances are also such that we are likely to see only an acceleration from here.
You know, in the speech, Mr. Ambani did mention that starting 2020, the International Maritime Organization will require shipping lines to use fuel with lower sulfur content, and how Reliance is well poised to benefit from that. Is that really a big deal in terms of how numbers could change because of that?
It's a very big deal. Essentially about, so one needs to understand this a bit more. It's not simple, but the headline firstly, you know, we feel that global refining margins in about 2 years could potentially surge by about $4 a barrel. In Reliance's case, we estimate this quarter is going to end at about $10 a barrel. So just on that one parameter, in addition to the petcoke, gasify, etc., enhancing margins, this could result in a 40% increase in gross refining margins. Now you need to understand, why does this happen? Essentially, the IMO regulation kicks in from 2020, which is barely, as you know, 18 months away. And what it essentially says is that bunker fuel for ships, the sulfur level has got to be cut down to 0.5%. Now, bunker fuel is essentially 1.7% of global petroleum products. So it's a fairly sizable number. Now, the shipping industry nor the refiners actually geared towards cutting this down. And therefore, to comply with the more stringent regulations of lower pollution, the ships will have to use actually diesel. We estimate for 5 years between 2020 to 25. And the demand for diesel is poised to surge. Now, in this circumstance, what happens is that the more complex refineries, such as Reliance, which is by far the most complex in the world, is geared to produce high-value products like diesel a lot more. And therefore, they will benefit hugely from the margin surge in diesel crack spreads versus you know, other simple refiners around the world potentially will be at the threshold of shutting down. This is just one aspect why refinery is going to do very well. The second thing is, we believe that for the next 10 years, the next decade, refining is going to be a very strong business globally. The reason for this is because by maybe 2030, with the advent of electric vehicles, gasoline demand will peak. Now, because of that, very few new refineries are being planned globally, because if you set up a refinery today, it's got to run for the next 40, 50 years. And if demand is going to start falling in about a dozen years, you're not going to set up a new refinery. And as a result of that, the demand-supply balance in the next 10 years is going to look very good. So there are two things here. One is the IMO resulting in margins rising sharply, which is what you referred to. In addition to that, for the next 10 years, the demand-supply balance looks very good. So actually, Reliance's refinery business, which is more than 50% of its profits today, is going to be a very significant driver of earnings over the next decade, basically.
Fair enough. I mean, that's a very detailed and lucid explanation of the triggers, the big two triggers. But what about the cash usage into into other businesses? I mean, the TMT entire business, which the cash is going into, and how that may turn out, the execution there, success or otherwise, how much of that will determine what happens to RIL, the stock?
So, in my experience, essentially Reliance goes through a long, massive phases of capital expenditure, and its capital work in progress goes up significantly as a proportion of its producing balance sheet. And then it goes through a couple of years of consolidation where it's got significant free cash flows. What we have seen, as I mentioned earlier, it's capex has been in the region of $55 billion and essentially about $30 billion of that in the telecom business. Now we are going to be in a phase where for a couple of years, the capex is going to slow down, including the telecom business. I mean, it's not going to be able to spend at the same rate in the telecom business as well, while its cash flows are going to go through the roof. So even if the capex in telecom is material, unlikely that it's going to be as material as in the past, because a huge amount of its backbone, its infrastructure has been built. It's now looking at more value-added services, essentially. Now, I do understand, speaking to various people, that the chairman has told the business leaders there that, you know, we have to plan for the next growth and capex growth. Now, that is a, I think, process that they've got into, but that's still going to take a couple of years before they start spending in the same magnitude, you know, going forward. So the next 2 years, in my opinion, are going to be years of significant free cash flow. See, Reliance's EBITDA already is in excess of $10 billion. In the next 5 years, that's potentially poised to double.